Let's take a look at the bearish trend. Now, last year, the equities market in Nigeria was rated about among the worst performers globally. Now, it seems that trend trickled, actually continued into the month of January.
Yeah, obviously, the same conditions that that ushered in the slide, half year ending December, prevailed into January. Indeed, some of them actually started seeing the real effects. For example, the pressure on the naira, the devaluation. We started seeing those towards the end of the year, and then, of course, into January. So you could say actually that January actually we started seeing the real-time effects across the market, okay, of the massive slide in oil prices. So yeah, it wasn't unexpected. Yeah, maybe the quantum was a bit frightening, because if you could lose the first week running in 16%, that was a bit frightening. And then that didn't abate even in the second week until the third week. So, and over this month, we've seen the market slide over about 14.7. Yes, that is, and this is all because, for me, the larger Nigerian economy is not yet mobilized in the market. Okay, because if you look at it, whereas from the NBS statistics, oil contribution to GDP and growth is declining. What you have there, you have services growing, you have agri coming on, you have trading. Now, these are the areas where the action is coming for Nigeria. It is not oil really, over time now. And so in the market, we should also see that kind of balance. Yes, oil index will be, going down with its pressure, but at the same time, there should be a rebalancing, using the services and all them sectors, telecoms and all that, as they come up. So we shouldn't have seen that kind of massive loss if that were the case. But when you have a market that represents an economy by just about 13%, then you expect that, most, and when, of course, when that market is now being propelled more by foreign participants, so what that means is we practically import wholesale what happens from the foreign economy right into the market, whereas those are not distributed across the domestic economy. So you see that whereas the domestic inflation actually came down in November, then ticked up a bit to 8% only in December. Why is that so? I mean, these pressures were also there. So the point here to take away is that the market, is significantly exposed to more foreign pressures than it is to the local economy, and that is what needs to be corrected. Local participants, for whatever reason, one way or the other, must be mobilized into the market. This market must represent the economy way to 40, 50, 60% of GDP, and that is the only way you can, as things go up and down, there will be a balancing. Yeah.
Now, Rotimi, despite the volatility, some listed equities still came to raise money in the form of rights issues. That's a bit contradictory, because one would think, all right, the market environment is not friendly. We have a high level of volatility, some kind of apathy in the market, but some quoted companies still felt this could be the right time to raise the money for our existing shareholders. And that brings us to the office markets, the rights issues that we had in January.
Well, for the rights issue, I would want to believe that it's not actually what we see right now is not representative of a very vibrant market. For the very first time in history, we have a right issue ongoing, and we have the price devalued while the right is going on. And that actually happened for Owando PLC. The initial time that the right came out, it was supposed to be for 22 Naira. And maybe while they believed that participation was not really effective, they brought down the price to about 16.90. We also saw same thing happening for Access Bank. Access Bank too is presently in the market. The initial price they were looking at was about 8 naira plus. And when they saw that that price couldn't fly, they had to cascade down to about 6 naira 90. Likewise, UBA was supposed to go for about 6 naira, but eventually they came to the market at 4 naira. And that doesn't actually interpret to success for these right issues. I think for me, the way I'm looking at it, the only one that may have a better, that may have a good success out of this trio will definitely be Owando PLC. And but for the likes of UBA and Access, even the volume that UBA is doing is small, and the price is relatively unbelievable as what we have right now. But at the same time, I don't really see much of success coming at, for those stocks. And also, the fact remains that normally when a rights issue is ongoing, it's supposed to be at a premium to the secondary market price. But we have the reverse for all the securities involved at this point in time. So small-scale investors would rather prefer to come to the secondary market to take up whatever volume that they need and ascertain that they already have it, rather than go and take up their rights. So it's only those that may want to take block positions that will actually go ahead and take up their rights for now.
Do you think this would affect the chances of these companies to raise the projected amount of money from the rights?
Definitely it's going to affect it. It's definitely good. I don't see any of them coming out, except, like I said earlier on, it's only Owando PLC that I believe will do much better than the other two. But for the likes of Access and UBA, the outcome is definitely going to be ridiculous. We saw what happened to Transcorp Hotel. It was barely above 50% subscription. And otherwise, if it had dropped below that value, they could have cancelled the offer. So we just see about the same thing playing out for the other two that I've just mentioned.
Dakuko, do you think there would have been an alternative to this? Try to maintain market stability, ensuring that the price of the secondary market is not lower than the issue price. Do you think there would have been another way of actually going about this rights issues?
I don't think there was going to be any other way around it, because you can't, these factors are external. You can't really influence them as a company. You've done your projections. You know where where it is useful for you to come to the market, the quantity, the price, and all of that, and you built your model. Market doesn't support it. What are you going to do? It's either you come, and like Rotimi has said, the offers may succeed. They may succeed mainly if you could find block investors who want to take, because now if Rotimi and I don't take up our rights in Access, okay, those could be brought together, and somebody who wants 5% of the company could come and pick them all up. Now, if he's going to come do that on the market, it's obviously going to drive price up. So at UBA, selling at 350 in the market, whereas rights is 4 naira, somebody is willing to take that premium to go to the rights end. So it may succeed only if there will be block buyers. But for retail buyers, that is a no-no. Absolutely, because why would you buy Access at 690 when you can easily pick it up at 520 just as you want, So I don't know how they would have gone around it, except just suspend the offer,
All right, and that brings me to the issue of cheap valuations or low valuations in the market. Rotimi, how would you assess the value of the stocks that we have and the markets?
Well, majority of them are actually trading at a discount of their prices. Looking at First Bank has 7 naira. We've had it for a very long time in that position. And to me, these prices are quite ridiculous. Any investor that knows his onions will definitely come into the market right now, take up positions, and just sit with it. The market is a long-term market. It's just we've allowed too much room for speculators to determine the pace of the market.
Well, could you have ruled them out on the market? Do you think there's a way of barring them?
Well, you can't bar them, technically. You can't bar them, how do I put it now? Now, but at the same time, if the participation within the market is what it ought to be, the extent of volatility that we are seeing won't have been there, and it will have reduced the extent of the participation of speculators. So, and as such, I want to believe that we can actually take them out if we go all out to market more investors into the market. Then that way, when the participation is broad-based, then we can actually take out the speculator, but not completely.
Dagogo, do you have anything to say about speculators in the market and how they had impacted on performance in January?
I don't bother about speculation really in the market. I could be bothered about speculation in the forex market, but not in the stock market. The reason is because there will always be two tranches to the investment in the market. There will be those who the value investors who will invest for long term. I mean, that's an asset I've created over years. There are those whose responsibility, the typical traders that will do 1 day, 2 days, 1 week, 1 month trades, one quarter trades. And you can't begrudge those who want to do that. And that is why I am not particularly worried about being spectators and
about speculators.
What the market will need is that the value investors should typically be far more than those who want to hold short-term positions. And if that is the case, then you have a very vibrant market where both segments of the market, interact with each other and present everybody the opportunity they desire. If I want to play 50% or 60% of my position long-term, I want to play 20% or thereabout short-term. And these are all asset mixes that will work for everybody. Okay, so I'm not particularly worried about speculation in the market, yes.
All right, I think we would expect that the month of February gets better. We hope that that turns out to be the case as we wrap up this conversation. Thank you so much for coming. We do appreciate the time. Rotimi Fakayejo, the CEO, Enterprise Capital, and Dagogo Iyoma, CEO, Milestone Asset Management. Thank you for coming to talk to us.